Hello everyone, my name is Eric Belasco. I'm an associate professor at Montana State University in the Ag Econ and Econ department. And today's webinar is going to be focused on Introduction to Risk Management. So just a couple things that we're going to focus on today. I'm going to start by just giving kind of a basic overview of how we use risk management in our everyday lives. And then talk specifically about the different elements of risk in cattle production. And then conclude with an example of some of these different strategies that we can use to manage price risk in cattle production. And then I'll kind of end with that. So hopefully by the end of this talk, you end up with a better idea of how you can manage against downside price risk. So we'll start with just kind of introducing risk management. There are three examples that I'll talk about today just to motivate areas where we buy insurance in our lives. So even me, I'm a university professor. I have areas in my life where I buy insurance. Three examples: home insurance. Many of you, if you buy a home, you buy home insurance just in case something adverse happens to your home. And so you pay a premium every month. And then if something happens to your house, you are paid then by the insurance company to compensate for your losses. The same is true with auto insurance. So I've unfortunately had some experience with this recently. But with auto insurance, again, you pay a monthly premium that goes to your insurance company. The insurance company tries to rate it so that they know about how much money they're going to be paying out to you over the long run. And then if you get in an auto accident, if you get a minor fender bender or whatever happens, your insurance company then compensates you after you pay your deductible. So, for me recently, I took my car in, had some body repair on it, and then I had a deductible that I paid, and the insurance company paid for the remainder. Health insurance is also one that has more recently become an area in our lives where we have insurance. And again, I have three kids, so health insurance has been an area where I've spent a lot of money over the years. But again, we're paying monthly premiums that go to an insurance company, and then when we go see the doctor, when something adverse happens, we have this policy. So each of these areas, again, we pay a premium, and if something adverse happens, we have a way to offset those losses. And we'll talk later in the presentation about how this has applications in agriculture, how we can think about insurance as what are the times where we're going to lose money, perhaps, and how can we set up an insurance policy to compensate during those times when we do lose money. So why do we buy insurance? And there are kind of three main reasons. The first one I think is the most important. Many of us would like to have consistent income. We don't want to have heavy losses in any given year. And so we'd essentially like to smooth out our revenue. And so by hedging, what we're able to do is offset these losses in bad years and basically smooth out our income. The second reason is there's just less worries, right? If I didn't have homeowners insurance, every time I had left on a trip, I would be, wanting to check in on how the house was. And so, less worries. Third, planning is also easier if we have a pretty good idea for costs and revenues for a given year. So whether we're trying to have insurance for revenues or costs, it's just easier if we have a better idea of what our revenues are going to be. And so what I'm going to introduce is just some insurance definitions as it pertains to agriculture that we're going to talk about as we go forward. So these are terms that I'll be using in some of the examples, but I wanted to just spend a minute to talk a little bit about each of these terms in particular. So first we have what's called a forward contract, which is basically an agreement to buy or sell a commodity for a set price. So think about a buyer and a seller getting together, agreeing on a price, agreeing to maybe other terms of a deal. Maybe they agree on a date or an amount, and they basically set that price. The important thing is that a forward contract is directly between two parties. And we'll have an example later where we have a cattle buyer and a cattle seller. So there's no third party involved in a forward contract. If you're in the grain market, you might set up a forward contract with a grain elevator, for example. Another definition, hedging. So hedging is the use of an instrument. Examples of that could be a futures contract or an insurance contract, but it's designed to offset losses. So the idea of hedging is just basically you are taking precautions, and usually those precautions are going to cost some amount of money. When I buy, auto insurance, I'm buying that policy to offset my losses. And usually that costs, it's usually not free to offset that risk, but I'm paying some amount of money in order to offset those losses in adverse conditions. So again, hedging is just one way to steady our income or revenue. Two contracts that we'll talk about later. First is called a futures contract. And one important thing with a futures contract, and then in a second we'll talk about an options contract, these are both sold through a third party. So there's a third party entity. You don't have a cattle buyer and a cattle seller directly interacting. You have both of them interacting with a commodity exchange. And so there's this third party involvement in both a futures contract and an options contract. So a futures contract is an agreement to buy or sell a standardized amount of commodity at a specified time and price. And so we'll talk a bit later about how these futures contracts are standardized, and that just makes it easier to kind of buy and sell. So we'll talk about a feeder cattle contract, but you could also have contracts in corn, soybeans, wheat, and they're all going to be standardized in one way or another. The other kind of contract that we have is called an options contract. And this is agreement, it's very similar to a futures contract, but the main difference is that it provides the right but not the obligation to exercise the contract. And the reason this is important is because a futures contract, you might lose money on a futures contract. If that were an options contract, then you just would not need to exercise it. And that might sound a bit complicated at this point, but we'll run through an example later. Both of these can be used to hedge price risk. So both of these can be instruments to eliminate risk of prices falling. And we'll talk later about how that works out. So just to start off with just a simple insurance example, and again, this is, the starting point is what we call an actuarially fair rate. And so an actuarially fair rate is just when the premium that's being charged is equal to kind of the expected losses, or you can think of it as the average losses. So if my auto insurance policy, for example, were actuarially fair, and it's definitely not, but if it were actuarially fair, then the premium that the insurance company would charge me would be equal to what they expect to pay out in terms of losses. So what the auto insurance company might do is collect data on people, from my age group, my demographics, and try to anticipate the amount of losses that they might pay out to someone like me every year. And then they would basically charge that in terms of a premium. So assume that we have this simple example. Assume it's likely that I'll be in an accident once every 10 years. Okay, so once every 10 years I get in an accident, and the cost of that accident is $2,000. Okay, so we don't know what year that'll happen. It might happen in year 1, it might be year 2, year 10. But once every 10 years, I'll be in an accident and the cost will be $2,000. So if we're calculating the actuarially fair premium, what we would do is take that cost of $2,000 and just divide it by 10, and we would say the actuarially fair premium every year is $200. And you might think, well, gosh, that actuarially fair premium might be worthwhile to pay for an insurance policy if maybe I were constrained. And I think of the times when I was younger, maybe didn't have some extra cash sitting around. And when I was in college, for example, if I'd gotten in an accident and had to come up with $2,000, it'd be kind of tough. And so maybe $200 a year I could come up with. But again, this insurance is just a way to kind of offset that big loss and just kind of pay it in, little by little over time. Most insurance companies, and I mentioned earlier that my insurance policy as an example is not actuarially fair. They have what's called a markup or a loading factor. And that allows those insurance companies to, hire people to collect this data, maybe to make money, make some sort of a profit as well. And so a lot of these companies will charge at least, a 20% markup. So if that were the case, let's assume it is a 20% markup. My premium now has gone up to $240 a month. All right. So again, am I gonna buy this insurance policy? It's gonna be $240 per year, and I know I'll be in an accident once every 10 years. Is it? Should I do this? Should I not do this? And this is the question we often have in insurance: is this worthwhile? Over the long run, I'm going to pay a little more, but it might offset my losses. Maybe I can't come up with that money right away. These are all kind of considerations to think about. So should I buy insurance here? Would I rather pay $240 every year than pay $2,000 at once? So clearly, over the 10-year period, it would be less. It would be less costly for me to just save $2,000 as opposed to paying $240 per year. But the big question is, can I afford the one-time hit? So if I were in college, I would probably buy this insurance because I couldn't afford the one-time hit. Now, I might just try to save that $2,000, put it away, and just have it ready for when something happens like that. There are some other options. Maybe I should have a higher deductible, and higher deductible usually results in a lower premium. Maybe I should only focus on the big losses. This is a simple example. In reality, it's probably not the $2,000 losses that we're worried about. It's some of the bigger losses. So what about agricultural insurance? Should I buy agricultural insurance? And I think the biggest benefit to buying insurance in agriculture is just that it provides a floor to revenue. So at a minimum, this is what I'm going to come up with this year. And so the way that you kind of establish where that floor is, some people will look at their break-even price and they'll say, okay, I want to establish a floor right at that break-even price. Maybe it's a little bit below it. If prices are really good, you can establish that above it. The benefits that gives, first is it gives you better access to credit. So you can go to the bank and you can say, look, I'm guaranteed to make this amount of revenue this year. And, that is more likely to give them confidence in lending you money, for operating loans or whatever it might be. The second benefit is just it's better for long-term planning opportunities. So if again, the minimum level of revenue, that, okay, I will be around next year. I'm not going to just, go out of business this year after I get hit with a big loss. So buying some insurance can establish that floor, and, those two benefits are there for that. So let's talk specifically about cattle production. There are really three main areas of risk in cattle production. If you're running a business, a cattle business, there are a lot of other kind of legal risks and things like that I'm not going to talk too much about. Labor risks, but these are kind of the main risks that we're going to talk about today. Output price risk is kind of the big one. That's the one, in fact, that you have the most control over hedging. It also is, I think, the largest factor of risk in overall revenue. So it's really the area to focus on. If you were really just to focus on one area, focus on output price risk is the main area there. Second area, input price. So think about the cost of feed. If a drought hits this area, how much is it going to cost to buy hay? Am I going to have hay available? And then third is just production. So you can see weight gain rates vary based on rainfall. Maybe it's colder than normal. My animals don't quite put on the weight I'd like for them to put on. So those three factors are kind of the three main areas of risk. Talk about price risk, and again, this is kind of the main area we're going to focus on. Just a quick glance at the some of the futures markets. And so these are the prices that I use the most, which are the futures markets, and you'll see CME there. That's the Chicago Mercantile Exchange. These are contracts that are sold. Each contract has a buyer and a seller, and so they tend to reflect the national price for feeder and then fed cattle. And you can see, what I'm trying to illustrate here is there's not really a period in time where you see prices stable, right? They're always moving. They're always moving up and down. If you were here in 2014 through 2016, you saw pretty wide swings in price. But even today, even though prices are pretty close to where they've been in the long run in real terms, there's still quite a bit of variability as they go up and down. One measure of that volatility we measure is the standard deviation on a monthly basis, and as you can see, this never hits zero, right? It's always pretty high, and in fact, the last 3 years, it's actually been pretty high, about 20% volatility. So that means every month the price moves about 20% of its typical level. So why are prices so uncertain? And this is what economists spend a lot of time on, focusing on how these factors impact prices. So there are supply factors. We could have a drought. We could see new technology. Those things can all affect supply. Demand factors can also have a big impact on the price. So we could have the price of chicken and pork can change. That can lead to price changes, disposable income. International exchange rates, trade environment, all these things can influence prices, and they're all constantly moving. I'm going to kind of skip over this fairly quickly. How can we estimate local prices? So I'm going to spend a lot of time talking about futures prices. Again, that's sold on an exchange in Chicago. How does that relate to the price you receive in Montana? Or what we call our local price. And really kind of the way that I think about it is I use the futures market, I try to estimate basis, and then I add the two together and I get an expected local price. And just to talk a minute about that, or an example, we might see a price of, like, let's say 159 quoted on the exchange, and then we have about a $6 negative basis here, and then that would lead to a local price of 153. And so this breakdown is kind of the way that I like to think about it. Estimating basis is not that easy. One way that you can do this is to calculate moving averages. If you come to my office, you'd see probably a worksheet similar to this, and you'd kind of work through it to see the seasonality and basis. I would recommend you don't do that. What I would recommend you do is to basically use some online platforms that do this work for you and just basically give you the answers. And one tool that I've found particularly helpful is this beefbasis.com tool, which will give you, if you put in your state and fill in some stuff, they'll give you an estimate for basis, and they'll use the futures market, and they'll basically give you an expectation for your price. So if you wanted to go in, and our example will be if you wanted to sell for October 2019, what should I expect for the local price to be? You could go in here. They're going to look to the futures market. They're going to estimate some basis component, and then they're going to give you what you should expect for your local price. And that'll be helpful for some of the hedging techniques we're going to talk about here in a minute. Production risk, for cattle production, we're talking about weight gain, we're talking about, forage, and, there's a couple different ways to mitigate some of that risk. If you're talking about the quality of forage or the cost of feed, inventory storage is one way that many ranchers in Montana overcome that type of risk. So you store in good years for other years. The other way to look at it is there are federal programs available that are essentially insurance products to insure against adverse weather. So two examples here I have are called PRF and LFP. I'll talk about those here in a minute. PRF is basically, it's called pasture rangeland forage. That's offered by the risk management agency or by a local crop insurance salesman. And that basically, you pay a premium And then if it's drier than normal, you get an indemnity. And the idea is to offset your losses from a drought that might occur. And those losses might be in lost forage production, perhaps. The other program is the livestock forage program. This technically isn't an insurance product. It's a disaster program because you don't actually pay a premium. What happens is if you're in a county that is designated as a disaster area based on the Drought Monitor Index, then you can go to your local FSA office and sign up and receive a payment for this. So it's a disaster program in the sense that there's no premium paid up front for it. The payments for LFP tend to be smaller than PRF, just in general. Okay, so let's talk about agricultural insurance now. And there are really four main ways to manage price risk that we're going to talk about here. And I'm going to go through each of these in a little more detail, and we'll work through an example of how each one of these would work. The first price risk tool, and it's not really a price risk tool, but it's just basically it is without any hedging. So no hedging, just called the cash market. So the example here is you're thinking about selling some cattle next October. Cash market would say, well, you know what, let's wait until next October. Let's go to the auction barn and let's see what we get. So there's no hedging involved in that. The second option is a forward contract. We talked about that a little bit before. Remember, that's between a buyer and a seller, kind of establishing a contract ahead of time, establishing a price and a delivery date and some other things. Forward contracts you can get in like live auctions or online auctions. We see forward contracts where you have a buyer that commits to buying your cattle in say 3 months from now. That would be one form of a forward contract. And then we have what's called a short futures contract and a put option. And we'll go through all four of those in a little more detail, well, 3 of them in more detail. So here's our hedging example. You're a rancher. You're looking to sell 70 head of feeder cattle in October 2019. So in about a year, you're looking to sell those cattle. You anticipate their average weight to be around 700 pounds. And you're looking at these 4 marketing strategies: cash market, forward contract, short futures contract, or a put options contract. And you want to see what are some of the differences between these 4. Your expected sale date is October 2019. And just kind of a brief look out in the market, what you see is that forward contract is going to be around $150. So that means you have a buyer out there who says, okay, I'll give you 150 pounds per 100 weight if we kind of lock this in today. You deliver me those 70 animals next October, and I'll guarantee you $150 per 100 weight. So you get that offer and you say, okay, let me take a look at the market. And you go to the Chicago Mercantile Exchange website and you see that the futures contracts are selling for $158. And you say, okay, that's interesting. I should take these into account. And just a couple of questions I have here. Why are these prices different? Well, the first reason is the futures contract is based on a national average. It's not based in Montana. So it could reflect some differences. It's also meant for a certain type of cow. Maybe you have a genetics program that brings you a premium. In that case, you might have a positive basis. Or you might have beef that's sort of known to have a higher quality. Again, you might have a positive basis. A couple other differences is that futures contracts are settled daily through what's called a margin account. We'll talk about that a little bit more in a minute. A forward contract is settled just once at the end of the contract, and that is also something that is important to note here. All right, so let's first talk about a forward contract. Okay, so the forward contract, remember that was the $150 that you got from a buyer out there. This is a contract that is directly between a buyer and a seller, so there's no third party involved in there. Typically, what you would establish are things like the price, the sale date, and the amount. So you might say we're going to sell on this day and this amount, right? So you're selling, in this case, you're selling 70 head of cattle. and you anticipate 700 pounds. This particular type of contracts eliminates what we call basis risk. Basis risk, when I talk about it, it's the difference between what you get in Montana versus what you get on the exchange. So basis risk is basically just that difference. So if you look to the, remember in this example, we had, you were getting 150 for a forward contract, and the futures contract said 158, right? So those two things were different by $8, so that would give you a negative basis of $8, saying the local price is lower. The important thing about a forward contract is that you actually need to go out and find a willing and reliable buyer, right? So you need to find that buyer, and hopefully you have some trust in that buyer, because if the buyer walks away, your sort of legal recourse is, maybe you find a lawyer and if you have a contract, but there's no third party that's kind of settling things for you if that buyer walks out. And the last thing to consider, what if the commodity is not available to deliver? So let's say you have some bad weather, and instead of 70 head of cattle, you only have 65. What does that mean? And usually that kind of stuff is spelled out in the contract. So, quick example here. Let's assume that you get to October, and remember the price that they were going to offer you was 150 per 100 weight. And when you get to October, the price has fallen to 132. Okay, so again, price has fallen. This could be for a lot of different reasons. If you had just priced on the cash market, right? So if you went to the auction and you sold and you got that 132 price, your revenue would be $64,680. And again, all I'm doing there is just taking the number of head times the weight times the price. Okay, so your revenue is $64,680. If you had a forward contract, so again, even though the local price right now is 132, the buyer committed to buy them for 150. So when you go in and when you actually transfer it over, you're getting that 150 price. So because of that, your revenue is higher by about $8,000 in this example. Okay, so in some sense, even though the price has fallen, your revenue has not. Your revenue is still exactly what you expected it to be a year earlier. And that's part of the benefit of hedging, is your revenue is going to be. Okay, what about a short futures contract? So this is, you're going to go to a physical exchange. This is a third party. You're going to purchase a futures contract on an exchange. And the basic idea there is that you're going to buy a contract that will be separate from a physical sale, but you're going to have a contract that is going to gain value if the price falls. It will alternatively lose value if the price increases. Okay, so that's kind of how you hedge. So you have a contract that offsets your losses. In order to establish these, you need a broker. So someone who's a licensed broker in town who can actually make this transaction for you. And you also need what's called a margin account. So these are settled on a daily basis. So if the market moves against your contract, you need to have a margin account that's going to transfer money over to somebody else. Basis risk remains because the local price isn't really important in a futures contract. It's just the national price. And the exchange will ensure that the money is transferred. So here you don't have to worry so much about the buyer leaving, because the third party, the exchange, will take care of making sure that buyer pays you if you are owed money. So, to get these quotes, you might go to a website like this, cmegroup.com, and you look and see there's a bunch of different futures contracts out there for different months, and you see they have different prices as well. Each of these contracts are specified within a certain weight. They have a certain quality or consideration. For the feeder cattle contract, they're worth 50,000 pounds per contract. For most of the grains, it's 5,000 bushels. Each of these are standardized. They're sold in certain months, and they expire at a certain time. So let's work out this example here. So let's say you take a short hedge, which means you buy a short futures contract. Okay, remember, price has fallen, So now what you do is you go to the sale barn and you sell your animals at the local price at 132. But you have this gain in the futures contract. So your futures contract has gone up. Remember, you bought it at 158, and now the futures price is 138. And so you have a futures contract that has a value of $10,000, which means you have this account with this broker. So in your margin account, you now have a balance of $10,000. Okay, so and again, you have a contract that's going to offset your losses there. So you are better off with that forward contract than if you hadn't hedged. Okay. The final option that you can use is what's called a put option contract. And this, put options, to be honest, are pretty complicated, but the idea here, I'm going to make it pretty simple for you. A put option is just basically an insurance policy against prices falling. So you're basically going to pay money to buy an insurance policy against prices falling. And in that way, if prices fall, you have a contract that's going to be worth something. But if the price goes up, then you don't have to exercise it. Okay? So put options are nice because they basically just take out the downside risk, but they still allow you, if prices go up, to benefit from that price increase. Just like with a futures contract, you need a broker. You don't need a margin account, but you do pay a premium up front. Okay, so in this example, the premium would be about $1,600 that you would pay to have this insurance policy. Basis risk remains, meaning that there is some difference between this exchange and your local price. And again, the exchange will ensure that money is transferred. So if you have a put option that has some value, you can have some assurances that there'll be money in there because of the third party. We have strike prices, some terminology to go through. I can kind of skip through these, but if you have the handout, you can kind of look at these. Basically, in the money means you have a contract that's worth some money. Out of the money means it doesn't have any value. Strike price is essentially where this pivot happens, where it goes from in the money to out of the money. For a lot of times, if you're in the cattle business, your strike price you want to set so that you can make your break-even price. So here's an example. Let's say we buy a put option and we establish our strike price at 150, which means if the price falls below 150, it's going to gain in value. Okay, so again, because prices fell to 138 in the futures market, then we would take our animals, we would sell them in the local market at the 132 price, but then we would have a contract that was worth some money. So this would gain money, $6,000 in the contract, minus the $1,600 that we already paid in premium. So once again, we're better off using this than if we hadn't hedged at all. Okay, let's do kind of the flip side of this. What if the price increases? What do we do then? So here in this case, the local price goes up to 162 and the futures price goes up to 168. Okay, so this seems like a good time to be in the cattle business. Price went up, and here are some of the calculations. So again, if we knew prices were going to go up, obviously we would want to use the cash market, although we never know where prices are going to be. So that's why we buy insurance. If we had settled into a forward contract, and again, the local price was 162, but we agreed to sell for 150, we might be kicking ourselves because we're missing out on that $12 per hundredweight. So we're going to lose a little bit of money there. Short hedge, same thing, right? So now we have a contract, we go and sell for the 162, but because we're on the short side of this futures contract, we actually have a futures contract that has lost value. So we have gains in the local market that are offset by our futures contract. So we're effectively, in both the forward and the futures contract, we're kind of guaranteeing our price. With the put option, you'll notice that we sell our animals for 162, and then we just allow this option to expire, right? So we pay our premium. In this case, it was $1,600, but that's the only bit that we're out there. So we sell our animals for 162, we pay our premium. Put option allows us a little bit, better revenue if that price goes up. And just to kind of look at this graphically, we can see here the blue line is the put option, and you can see where it is flat. It's flat just above 140. But if that futures price gets above 150, we can see that the put option starts to increase there. The purple line and the green lines are the futures and the forward contracts. They're basically level all the way throughout, right? Because it doesn't matter what the futures price is, we've basically locked in that price. So if prices go up or they go down, we've locked in that price. Cash market, you can see, has the most variance because it's just, you know, it's up and down. Okay, so of all these, the cash market has the most variance. The put option takes out the downside variance, but not the upside variance. So just to kind of summarize, you know, hopefully those three marketing strategies make some sense to you. Granted, they're all very complicated, but if you have more questions, please contact me. But basically, forward contracts allow you to just work with a buyer directly. Futures contracts and options contracts are both through a broker and allow you in some different ways to manage price risk. So just some questions to kind of ask as you're going forward. You know, are you prepared for adverse events? You know, drought can usually bring upon its own risk factors. Market prices, are we kind of ready for those things? And, you know, before they happen, do we have a good plan to mitigate that risk? So thank you so much for your time. If you have any questions, comments, or feedback, my email's right here. I'm on Twitter as well, which is always a great place to open discussions like these. And I would also encourage you to check out our website here in the department at aggieconnmt.com. Thank you so much.